we gave a difference between non-discounting and discounting techniques, and the major difference, as we discussed, is time value of money, where we said that discounting techniques take care of time value of money, the time period when the cash flows are being realized, but non-discounting techniques do not take care of time value of money. It ignores. But we know as finance analysts that time affects value of money. So we started from the first method of discounting techniques, and that is discounted payback period. And we started doing a computation to help us understand it better. So in the computation, we already did the first part of it. And in that computation, we were using an example of a question under Advanced Financial Management in the CPA course, which was a sitting of May 2014, question number 2B. So that is the sitting from where we got the paper, the question, and we started discussing it. And I'm here just opening that question and share with you very fast so that we can do the remaining part. And the most important thing, ladies and gentlemen, that we are talked about is getting to know why we are using these discounting techniques, and we are giving less preference to non-discounting ones. So I will pull down this screen so that I share that question very fast. Let me share that question so that we can do that part remaining. Now, in the question here, that is question number 2, part B, we were given two projects, Project X and Project Y, with initial investments and the cash flows that are projected to be realized in the next 6 years, which is the project life. Remember, the cost of capital was given at 15%. And with that, we were told and required to compute discounted payback period. And we already did for Project X, which is the first project. So we are supposed to go ahead and do the same for Project Y. So that's what I want us to do. So let me pull it down and share where we are doing our computation. Good. Now, let's do it. Let's do it. Now, if we look at the first one, which we did, and the key points that you need to remember and pick. I told you to do project evaluation or project appraisal using discounted payback period. We need to know what is discounting, and I gave you a difference between discounting and compounding. Discounting is where you have a future cash flow, a future expected cash flow, and you want to get its present value, its value today. Now you are discounting from that future value to the current one. And if you want to get a value of a figure or a projected value for the future value when you have the current one, what you're doing is called compounding. And the difference between compounding factor and discounting factor is the N, the period. So if you look at the right side, the formula that I wrote on the right side, where I said present value is 1 plus R close bracket raised to negative N. That is when we are doing what we call discounting, where we are raising to power negative N. Remember, we are working backwards. We have a future value and we want to get the current value from it. We are working backwards. That's why we are raising to negative N. That is discounting. But if we are compounding to get a future value, look at the formula we wrote on the left side, where we said future value is 1 plus R raised to N. Now that one is a compounding formula. Now here, we did a solution where we were discounting the cash flows expected from Project X. And you remember how we were getting the discounting factors? And I told you two ways of getting the discounting factors. You can get the discounting factor using your calculator, or in most cases in an exam room, you will be given a discounting table, and there you can see the discounting table, which I'm showing to you right now. So in an exam room, you will be shown this discounting table. And I told you how to pick the factors from the discounting table, where you are looking at the period and the discounting rate. So given the discounting rate by in the question, whether it is 10%, 15, 12, 5, 6, or any number, you just come and pinpoint where the percentage discounting rate is, or the cost of capital. Then you look at the period column to see which year do you want to pick its discounting, discounting factor. So you move along the row and the column to identify the point at which you want to pick the discounting factor. I believe we are going to also do the same as we do this part B, or the next part for project Y. So let us go ahead and do the computation the same way we've done for project X. Let's go ahead and do for project Y. Very good, very good. So now we already got our payback period, discounted payback period for project X. So we are going to do the same procedure to do the payback period for project Y. Very good. So let's go ahead and do that. Let's go ahead and do that for project Y. And if you are new in this channel, I'm CPA Samuel Otieno. And here in this channel, we do business data analytics lessons. We do advanced Excel lessons. We do practical accounting and coaching on various aspects of accounting, including accounting softwares. And most importantly, we are in the tax period, and we also wish to bring to your attention that we offer eTeams integration services. eTeams integration services. We are a third-party licensed, third-party licensed eTeams integrator by KRA. By KRA, we have a license to do that, and we can always connect you and help you be compliant by connecting to the KRA database. Then at the same time, we are also selling a point of sale system, which is hybrid. And this point of sale system, when I talk about hybrid, it supports both desktop version and it is also cloud-based at the same time. And you know that cloud-based systems are the current trend of systems where you have access to your data, efficiency guaranteed, and you can always use even your tablet, you can always using your phone, or you just pick that URL and use it on any computer, and you'll be able to access your data. And so now you can be able to see the level of efficiency that this system provides to you. And again, when you talk about hybrid, even if you do not have internet connection, your system will still work because the desktop version still works. And whenever the system detects internet connectivity, it will do synchronization. It will synchronize your data, and your data will be backed up in the cloud database. And at the same time, if your system is connected to the eTeams database, it will already remit that data which is supposed to be remitted. So if you need any of such services or more information regarding the same, do not be afraid. You can reach out so that we see how best or which product will suit your situation and help you spur your business growth. Now let's continue with what we were doing. We were doing project evaluation for project Y. So I want us to go ahead and do for project Y. I would wish to open a new page and we see project Y, project evaluation. So for project Y, we are going to do the same procedure which I talked about. And like I mentioned, the first thing is to do the first column to bring in the years. Just bring the years or the period, the years or the period. Then you bring on board the projected cash flows expected to be realized from the same project. Remember, you are doing evaluation at the start. You've not already done these projects. So whatever cash flows that you are given or that you have, they are projected or forecasted cash flows. You expect to realize them in the future during the project life. You haven't realized them yet. So that's why I normally use the word projected or forecasted cash flows. So we write the period, and the project life was 6 years, like that. After that, you bring in the cash flows as was given in the question. And I believe I've just shown you the question, and let me just bring it on board. So as shown in the question, we are going just to pick the same cash flows the way they've been given by the examiner, and I believe you can be able to see them. Project Y, you can see the cash flows given, 37,000, which is the initial investment. Then we pick the cash flows from 30,000, 8, negative 4,000, 22,000, negative 10, and then 15,000 for project Y. We already did for project X. So we move to project Y to compute the discounted payback period. That's what I'm showing you right now. So let us go ahead and do what we're supposed to do there. So let's go ahead and now list the cash flows